Knowing when to take advantage of down moves, knowing when you should actually invest your money is probably one of the most important things that I personally learned when it comes to options trading. Because the problem is you could stay on the side, you could stay on the sideline and basically never invest your money. You could absolutely do this. You're not going to get anything out of the markets if you are not risking at some point, if you're not willing to take risks. And that's why when we have this type of down moves like we had last Friday, for example, where the SPY fell by not a crazy amount of points, but quite a decent down move at least, we need to take advantage of those down moves. And let me explain why. This is the chart of the SPY, of the S&P 500 ETF. What we've seen since March, April 2020, we've seen a constant grind up. We can see that the market was around $372 per share and now it's at $465. We can see that it has been a constant grind up. So when you have a situation like this where a market constantly grinds up, it seems like it's never ending, that the market is always going up and up. When the market is going down, like for example last Friday, if we zoom a bit and we look at what happened, when you have this type of down moves, that's where as an option seller you really need to take advantage of those opportunities. And the reason for that is that premiums get extremely expensive when there is a sudden down move. And of course, like, the markets tend to fall a lot faster than what they grind up. That's, a fact. We all know this. But the effect of that when the market falls is that options are going to become a lot more expensive because the implied volatility is rising. So it's going to make options a lot more expensive. And when you sell options, the more expensive they are, then the better it is for you because you're going to make more money out of those options. And if we look, for example, just below the chart, you can see that there is this graph. This is the IV rank. If we look at, for example, what happened like last Friday, we can see that the graph, the IV rank, jumped like quite a lot. The IV rank is a bit like a thermometer for how expensive option prices are. The higher the IV rank, the more expensive the options are, and the lower it is, the cheaper they are. So when you sell options and you see that the down move is happening and you see the IV rank going that high up, and you could basically look at the majority of the stocks, and that's what exactly happened. You had the IV rank that went up, meaning that option prices got more expensive all of a sudden. However, how do you know, for example, when you see that the market is going down like it did last Friday, how do we know how low is it going to go? Because you obviously don't want to catch a falling knife, and me neither. For example, if I'm selling a put, meaning that I'm going to be bullish, then, if the market is going down, making options more expensive, and I sell that put, yes, I'm going to make more money. However, I don't want to catch a falling knife. So how do I know where is the bottom? Well, you don't. And if I knew, trust me, that I would be very rich by now. But the problem is you don't know how low the market is going to go. That's a fact. No one knows actually. But the thing is, if you don't take your chances, if you don't sell your options when they are expensive, then you might miss out on a good opportunity. That's exactly what I did when the market went down last Friday, is that I sold a couple more options. I sold a couple of puts on, for example, stocks like Alcoa, ArcelorMittal from the stock ticker MT, and I think I sold another one on Foot Locker, for example, and LVS. And I sold a couple of put options on those different stocks, ramping up a bit my portfolio usage because I just want to be there when there is high volatility. And the only thing that I think is worth doing, and if you're a bit scared of having the market going even further down, then just don't invest all of a sudden all your money. Go gradually. For example, the 4 puts that I sold on 4 different stocks, I think combined they just represent 3 or 4% of my total portfolio, which is nothing in the grand scheme of things, and have a ton of cash available if the market continues to go further down. So that's how I personally invest and sell options, is that as volatility gets higher and as the market is going further down, I'm going to sell more options, but I'm always going to be cautious because we never know how low the market is going to go. And you just, as I said before, don't want to catch a falling knife. And if I show you, for example, my portfolio tab right now, so those are all the positions that I have right now. And because I rolled some options and I sold some options last Friday when the implied volatility was really high, as today the SPY is going back up a bit. Like the SPY, if we look at the chart quickly, we see that it's coming back up today. Well, the implied volatility is also going lower, which is a proof of option prices getting cheaper. So you can see that basically today I'm making a bit of money everywhere. And one of the reasons for that is that as the implied volatility is going lower, then option prices are just becoming cheaper. And as I sold those options, for example, at a price of, let's say, $2. Well, now with the implied volatility going down, the option prices are only worth, let's say, $1.80, $1.70. So you're making money because you sold those options when the implied volatility was really high, and now they're getting cheaper, which means a profit as an option seller. And honestly, when I see today, I'm obviously telling myself that I could have sold more options on last Friday and I could have made more today. You know, like, you're always going to regret not having sold enough options or maybe sold too many options. I definitely rather be in the first position where I didn't sell enough options rather than too many, because that means you're in trouble. But you get my point. You're always going to have regrets. You're always going to be like, I should have sold more options, but you can go back in time. That's why every time, you know, when this type of situation happens, I'm always there trying to take advantage of the opportunity and trying to keep a lot of cash on the side in case it goes wrong. But overall, what I mean is that you need to be there when there's an opportunity. So what does that mean in terms of buying power usage? Because I think that's quite interesting to have like some guidelines and metrics to follow. When we are in a low IV environment, for example, let's say below 20 or let's say below 18, that's what I would call a low IV environment. When the VIX is below 18 or 19, I'm going to try to stick to around 15% of my buying power that is being used, meaning that all the positions that I have sold in my portfolio in total will take up to 15% of my buying power maximum. So let's say if you have, for example, a portfolio of $100,000, then 15% of that would be $15,000. So you're only going to invest $15,000 out of those $100,000 when the VIX is below, for example, 20. And the reason I'm not allocating a lot when the VIX is low is that if there is a crash that happens, then, you know, the VIX is going to blow up all of a sudden. My positions are going to require a lot more capital to be sustained. So I really need to be careful when the VIX is below that level and when it's just low in general, because that's where there is actually the most risk. Let's say that the VIX is around, you know, below 20. So that's what we would call a low IV environment. So let me write it so we make sure that everyone is on the same page. When you have a low IV environment, and let's say that you have a stock that is going to move, let's say, up, down, and up again. Let's say that you're willing to sell a put on that stock. When you're going to choose the strike to sell the put at, you're going to have to sell it at quite a close strike price compared to the current stock price. Is going to be quite close, and the reason for that is that there's not a lot of premium because the volatility is so low. Then options are not really expensive, so there's not a lot of money to be made. So if you're willing to sell a put in a low IV environment, you're going to have to sell a put at a strike that is quite close to the current stock price. So if, for example, the current stock price was, let's say, at $100 per share, to make it simple, well, the put strike would probably be, I don't know, let's say 98 to make it simple. But the problem is, if, for example, let's say the stock market comes to crash, well, the stock is going to all of a sudden plummet quite quickly. And as a result, your position that you had is going to go in the red. You're probably going to be in hundreds of dollars worth of loss, or if not thousands. I mean, that's just what it is when you're selling, for example, a put option and you have a crash that happens. You're going to be in a loss. But now let's see, how does that compare to when you're selling puts in high IV environments? If you're selling a put, for example, in a high IV environment, so I would call personally high IV environment anything where, for example, the VIX is above 20. So let me just write that. As the overall implied volatility is higher, then options are going to be more expensive overall. Each and every single option is going to be more expensive compared to what it would be in a low IV environment. So the thing is, as an option seller, you might afford to actually go further out the money, because as options are more expensive, you're going to collect more premium even if you go further out the money. So instead of having, for example, to go to the 98 strike, you can, for example, afford now, because you are in a high IV environment, to sell, let's say, I don't know, a put around the 90 strike. And still you're going to collect a quite enough premium, like a quite decent premium, maybe as much as the 98 strike, but now you are the 90 strike. And the reason is because there's more volatility, then options are more expensive, so you can go further out the money and still collect a good credit and still making the same amount of money as you would make at the $98 strike in a low IV environment. And same situation, if the stock was about to crash, then you wouldn't be as much in a loss as if you had sold the 98 put strike, because it's not going to be as far in the money as the $90 strike. Because you sold the $90 put strike, it's further out the money than the $98 put strike. This strike is further out the money compared to this one that is almost like close to the at the money. It's close to the at the money strike almost. So if there is a crash that happens, the loss that you're going to have is going to be a lot bigger on the $98 strike compared to the $90 strike. That's why when there is implied volatility or there is what seems risk, there's actually less risk for an option seller because you're going to be able to sell options that are further out the money. You're actually going to take less risk compared to someone who would sell options in a low IV environment. So because of that, because we know that there is more risk in selling options in low IV environments compared to high IV environments, well, does that mean that you should stay on the sideline if you like to sell options? Should you stay on the sideline during low IV environments? Well, I don't think so personally. I don't think that you should stay on the sideline and not invest your money because we are, for example, in an environment where the VIX is below 20. I don't think that's a reason to stay on the sideline. I think you should always get engaged, but the real metric to follow is how much of your buying power are you actually going to use. Personally, as I said, I'm going to use 15% of my buying power if the VIX is below 20, and then if it's above 20, for example, it goes to 30, then I'm probably going to go to 20-25% of my buying power used. I'm going to sell more options up to the point where overall around 25% of my buying power is actually used. And as you can see right now, my portfolio usage is of 17.5%. So I actually have a lot of room to play with. I could actually sell a lot more options to try to ramp that number up to 25% instead of 17.5%. But that's exactly what I mean. You're going to scale like your portfolio. You're going to scale your investments as there is more volatility because that means more money for you. There's more profit to be made. However, maybe don't go there too quickly. Like don't go overnight from let's say 10% to 25% because if the markets continue to go down, let's say you're in a crash and we just haven't seen that yet, well, you're going to get crushed on 25% of your capital. So you want to go there gradually. At least that's what I do. And doing this, over like 2020, 2021, of course, I mean, apart from the 2020 crash, this has been great. I mean, how could it not have been great? Like you see that the market has been going up for the last basically year and a half. And of course, because we're in a bull market, everyone is a genius. I know. But like that's where as an option seller, if you like to sell puts, then that's your moment to shine. If you want to take advantage of the markets, then that's exactly 2020 and 2021 has been exactly the perfect opportunity to take advantage of that because the volatility has basically been staying up for the whole time. And if you're not used to do this, if you're not used to, for example, ramp up your buying power usage to sell more options when the implied volatility gets higher, don't worry. Like honestly, it took me a lot of time to get used to this type of things, to, for example, selling more options when there is more volatility. But at some point, you start getting a hand on it, and the more options you sell, the more you trade, the more comfortable you're going to get with it. So don't worry if you don't do it yet, it's going to come. Now that we covered a lot of theory in terms of, for example, trying to ramp up your portfolio when the VIX gets higher, when the implied volatility gets higher and the market goes down, I want to show you an example of a trade that I would potentially take so it gives you a real life example. Right now I'm looking at the stock FCX, and if we look at the chart, basically the stock has been ranging since the beginning of 2021 between around $25 per share and $45 per share. And if we look at the graph below, so this is the graph for the IV rank. So remember that the higher the IV rank, the higher the IV for the stock in particular, and so the more expensive the options. And the lower the IV rank, the cheaper the options. So ideally, you want to sell options on high IV rank stocks because you're going to get more money, you're going to make more bang for your buck. Right now, the IV rank for FCX is around 47, so it's around right there. But if we compare it to where it was compared to the past year, is pretty much always like higher, is higher than the majority of days in the last year. So the red line is basically the current implied volatility rank, and we can see that pretty much all over this year the current implied volatility rank is higher compared to what it was before. So that's quite interesting because now you can actually see, okay, so now options on FCX are really expensive. So let's check, for example, the option strike, and the first thing that I would go in terms of expiration, I would probably go for the January expiration. Now the December expiration is a bit too close to me. I like to sell options when it's around like 30 days or let's say 40 days. So I would be tempted to go for the January 2022 expiration. So I'm going to focus on the put option side. So you have the puts on this side and you have the calls on the other side. The first thing that I'm going to look at, for example, all the different strikes. So personally, I like to sell options that are around the 25 delta. So for those who want to know what the 25 delta or delta means in general, delta is a Greek letter and it's often used in options trading, it refers to how much value an option would gain or lose if the stock was moving by $1 up or down. So pretty simple. And delta also has another definition where we also use it as a way to quickly know how likely it is that an option is going to end up in the money. So for example, if we look at the 33 strike and it has a delta, you can see in this column of 21. So you see that it's right there, then 21. It means that the 33 put option has roughly 21% chance of expiring in the money. So that's how we're going to use delta usually when it comes to options trading. And especially when we sell options, it means that if we have 21% chance of ending up in the money, then we have pretty much 79% chance of expiring out the money. And personally, that's exactly like the sweet spot for me where I like to land. So I'm usually going to go between the 25 delta and the 20 delta. So let's say that I'm going for the, let's say, why not the 34 put option actually, where I get a bit more premium. So if I sell the 34 put option, which is at the 26 delta, so it has around 76% chance of expiring at the money, I'm going to collect a credit of $1.24, which means a max profit of $124, which is pretty cool. And something that is quite funny to notice after a while, once you have been trading options for quite a long time, is that you know by just looking at the premium of a certain stock how expensive or how cheap it is, because you've been looking at, for example, similar strikes, similar deltas for other stocks that are priced in the same price range. You know when an option is too expensive compared to what it should be, just because historically you know that this option that is costing, for example, right now $1.23 usually costs around, like, let's say 75 cents, for example. So that's how you're going to become if you trade more and more options. At some point you just know like how expensive or how cheap an option is by just looking at the premium that there is. If we look at, for example, the stats just below, you have a 73% chance of basically making money, and you have an 82% chance of reaching 50% profits. So if we take 50% profit of $123, that's roughly $61 or $62. I have an 82% chance of reaching a profit of $61 on that position, 84% actually. So you see that it's quite cool to have all those metrics where it helps you build a portfolio, and now you know how to trade taking into account all those stats. If you've got any questions, you can just comment it below. It's always a pleasure to talk with you guys, and if you have any question or comment, I'd be happy to answer any of your questions. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.